Imagine a scenario where a country's financial stability hangs by a thread, with foreign money flowing out at an alarming rate, threatening to plunge its economy into chaos. This rapid exodus of funds, known as capital flight, can severely weaken a nation's currency, making imports more expensive and eroding the value of savings. What tools can a government deploy to staunch this outflow and protect its economic foundations? Capital controls prevent currency collapse by restricting the free movement of money into and out of a country. These measures are designed to limit capital flight, stabilize exchange rates, and preserve a nation's foreign exchange reserves, thereby preventing a rapid devaluation of its currency. The core mechanism at play involves reducing the ability of both domestic and international investors to quickly withdraw large sums of money. When investors perceive risk, they might try to convert local currency into a more stable foreign currency, like the United States dollar, and move it out of the country. This speculative selling of the local currency drives down its value. Capital controls interrupt this process, making it harder or more expensive to exchange and transfer funds, thus curbing speculative attacks and maintaining domestic liquidity. This also provides the central bank with greater autonomy to set monetary policy without constantly worrying about capital outflows. Countries implement capital controls through various methods. They might impose taxes on foreign exchange transactions or investments, making it less attractive to move money. Other approaches include quantitative restrictions, such as limits on how much foreign currency domestic residents can purchase or how much money can be invested abroad. Some countries also employ administrative measures like requiring prior approval for certain international financial transactions or even restricting the convertibility of their currency. This strategy becomes particularly critical during what economists call sudden stops, which are abrupt reversals of capital inflows that can trigger severe financial crises. Capital controls, when used judiciously, can act as a macroprudential tool, a preemptive measure to build resilience against such external shocks. By managing the volume and composition of capital flows, policymakers can mitigate systemic risks before they escalate into a full-blown currency crisis. Ultimately, the judicious application of capital controls can serve as a vital defensive mechanism, allowing nations to safeguard their economic sovereignty and maintain exchange rate stability during periods of intense financial pressure. They provide a breathing space for governments to implement necessary domestic economic adjustments without the immediate threat of a complete currency meltdown, fostering a more stable environment for long-term growth and development.